How do I manage risk in my mutual fund investments?
You can do it in three ways. One, you should know what is the risk you're taking before investing itself. Okay, there's a statistics called standard deviation. You should know what is standard deviation I'm getting into. So you know the risk initially. So try to mitigate the risk and what is the amount of risk you're able to take it. You take that way and invest a portfolio so that you will not be able to reduce the risk. You will know what is the risk you're taking before even entering the fund. Okay, that one way. The second way is the diversification. Diversification gives you that cushion of reduction of risk because you are diversifying your money into different asset classes, not necessarily different funds. Okay, I'll tell you what different asset classes means. You put some money in gold, some money in international equity, some money in a sector fund, some money in diversified equity, some money in a liquid fund, some money in a bond fund. So these can actually reduce your risk because all will not underperform at one chart. Okay, so this 360-degree, if you look at view, I think you have a well diversified risk adjusted portfolio which will automatically give cushion for reduction of risk. Okay, the third and last is that the reduction of risk can be done by not violating the rule. For example, you have a portfolio constructed for 15 years. Okay, make sure you don't touch that portfolio at least till 8-10 years, because whenever you put your hand, 95% of times you are always wrong. If you ask me personally, I also go wrong. So whenever I assume something and invested money for an investor, which is against the law of normal investing, we always fail. So in 2020, we told people to put money. People was not ready to do it. They've invested in debt. They didn't make money. Similarly, whenever the investment is being done, if you do not know the risk, at least if you know the goal, stick to the plan. So that can actually mitigate the risk of not making money. So risk taking is necessary. If you not take a risk, it's a big risk. Okay. So I think that risk is reduced. Your ability to generate the potential wealth, which is yet to come to you in the future, will not be disturbed if you don't touch the portfolio. Because I have personally observed the biggest risk of an investor is not making enough money, even the fund has made money. The gap between a fund return and an investor return. So that is the biggest risk compared to market risk or any other risk. We call it behavioral risk. We can say. So there are three ways you can actually do it. All three will do a good job. Any one of them can be a good portfolio.